Hey, good morning, everyone. Marty Mazzora here again. It's April 4th, Friday, 2025. This is just going to be a super quick snapshot and commentary on the market aimed particularly at our clients. So, folks, those of you who watched the video yesterday recall that I pointed to some technical levels here, and I said there wouldn't be really any resistance to a fall to about 5,200, and there should be some support right there. This blue candle right here tells you that at the moment, the market has really busted through there with momentum. The news, as I suspect you already know, is that China stepped up overnight with a retaliatory tariff of 36%. And the president said, I will never change my policy. So that's got the markets very upset. I said yesterday, peak uncertainty. However, we could get retaliatory tariffs and that would exacerbate things. And so this is the first salvo from one of our trading partners that is that retaliatory tariff uncertainty. So from there, technically, that 5,000 level right here is another area where there's really just nothing recently that would suspect that we should have much problem, or the market should have much problem getting there. You could bounce off of that though, so the support isn't lost at this point. It is for the moment, but you could see in this bear flag played out right now right to a T, but of course it could go further. So here's kind of my expectation, right? This is going to be our base case for the moment, is that the bear market probably isn't done, that the data that's going to come out over the next few weeks and months is going to be pretty ugly. But we also have the potential inflationary impact of tariffs. The jobs number this morning, ironically, was much better than expected, but the unemployment rate was up a little bit, and the market just didn't care about anything. So the powers that be, will step in ultimately. As I said yesterday, this is fact. The U.S. does not have as much fiscal firepower on the surface. That would be the ability to print money, to start spending it in the economy, as they did, say, around COVID. We did lots and lots, trillions of dollars of stimulus since then. And we got the inflation result for it. That was very, very destructive. It led to terrible political sentiment at the time for the powers that be. The Fed was embarrassed because they said it was transitory. It lasted longer. So that's going to be in the back of their minds, in that here we have a situation where the economy is suffering, but inflation is stubborn along the way. The term is stagflation, stagnant economy, right, with inflation. So that may create somewhat of a staying of the hand of the Fed, but I am going to stick with what I said yesterday, that they're going to be more concerned with their employment mandate than they are inflation mandate, and they'll deal with the inflation later. Of course, if this morphs into something pretty ugly from a recessionary standpoint, ultimately we will see inflation come down. Certainly the bond market is anticipating that. You're seeing bonds rally pretty well right now. So that's our base case. Now, having said that, along the way, I think we are going to get some dramatic, we'll call them rip your face off rallies. This, despite what the president said, clearly is getting under policymakers' skin. There will be, I suspect, announcements of a phone call that was made, of great discussions. Those are to come. And as we get those, this market that has taken such a dramatic dip over such a short period of time will have these incredibly rapid, I'll call it again, rip your face off rallies. That's how bear markets play out. The best days in the market, frankly, historically, have virtually always been during bear markets, right? So those of you who are looking at this too much and thinking about it a lot, I just kind of want to tell you what to expect. So let me speak then to kind of what's going on. So yesterday, when I shot the video, those of you who have just all of your money in our core portfolio, I'll speak to you first. Those would be if you just have a retirement plan. And there's no, special affinity position like some tech stock that you've been wanting to own forever, because that's gonna hurt your performance a little bit on a relative basis. Or if you're a nonprofit organization and we manage your portfolio for you. So yesterday, when I said how the core was doing, I said we were down a little bit less than 1% when the market was down like 4 or 3 or 4, and the NASDAQ was down 4 or 5. We ended up just over 1% down yesterday. Today, as I speak, the S&P 500 is down 4.5%. The NASDAQ is down almost 5%. The Dow, for what it's worth, is down another 1,500 points. So now our core is feeling it more today. So the core all in is down about 2%. So we're capturing a little bit less than half of the overall market decline. And we have some positions in there that are capturing a lot less. We have like long-term treasury bonds that are up 2%, but we don't have the large handful of things that were up like we did yesterday. Although I will say the yen is up 0.5%. Our long-term inflation-protected securities are up 1.3%. Our put options are up well over 100%. So that's large right now in terms of mitigating some of the decline. So after yesterday and today, we're still going to be up on the year just in our flat core allocation that impacts a lot of you, if not the majority of you, but just slightly, while the market is down, notably now on a year-to-date basis. Those of you who have just regular brokerage accounts, who you have had incredible runs in your technology stocks, that we've whittled away at them, but with that reluctance because of the capital gains taxes, and I've talked, many of you, this will sound very familiar because we've had these discussions, you're taking it a little harder than the core. Still not as bad overall as the overall market, but you also captured more of the upside when the market was rallying big time. So you'd have to go back all in, and you're still in pretty good shape. So I just want to reiterate here, though, that this, frankly, in the context of history, is not remotely out of the norm. Okay, what is out of the norm is the U.S. applying tariffs on its trading partners to the extent that it is. This market was more than due for a big correction / bear market. Anyway, as I said yesterday, these dynamics that we're sitting with today have virtually never resolved without a significant double-digit correction, typically a bear market. The textbook says anything over 20%. We have a different definition, but this right now is still a correction. But we do think the macro dynamics are spelling out a scenario that could lead to a bear market that will last a while, and that's something that that we'll feel. That's why we're hedging. That's why we own gold and other things. Speaking of gold, I don't have time to show you the chart today, but it's down 2% as well. Now, we did hedge it, though, and we did roll the hedge higher right at the peak. So we are offsetting 0.75%. So our position is only down 1.25%, while the gold itself is down 2%. Gold ultimately will have a good run, and I'm speaking from experience, in a bear market scenario, but typically at the beginning of the bear market, gold, as correlations pretty much sync, gold goes down with everything else. What's interesting today is, one of the things that helped us yesterday was healthcare stocks, very defensive. They're down 2.5% today. Consumer staple stocks, which is not a small position for us, it's down 1% today. So the things that were working yesterday better are capitulating today and falling with the market. Again, the hedges are significantly higher, and they have significant gains. Now, one of the things we're doing right now, I just got off a call with Nick and really kind of explored how to protect our hedge in a rip your face off rally scenario. So we're implementing kind of a countermeasure using options so that when we get these big rallies, we can experience more of them as the defensive hedge gives way. So I know that sounds complicated, folks. Clients, of course, always feel free to reach out to me directly if you'd like to chat about any of the dynamics about your portfolio or what's going on right here. Clients, I want you to know that I know this stuff can get under your skin. The news headlines are pretty scary. Not used to seeing these kinds of dips in the market. I have seen them in my 40-year career, I assure you. And we also know that ultimately there is a point where the market bottoms and it is a massive buying opportunity. We are anticipating some big snapback, counter trend, short covering rallies that we are tactically taking some measures to capture when they occur without abandoning what we think is our all-important hedge, if indeed this market has more to play out to the downside. I'll leave it there, folks. Thank you as always for watching and listening. I'm probably going to be back a bit more often as this plays out. Take care. Bye-bye.